Okay, class, this is it. This is the last PowerPoint recording that you will have to listen to in my voice ever. So that should make you pretty excited. So, Chapter 12, Reporting and Analyzing Cash Flows. So if you have not yet listened to the lecture on uh, the Chapter 12 actual material, please go back and do that. This presumes you've already done that, so some of the explanations won't be as thorough. So it'll help if you listen to that first and then come back to this one. So let's dive in. This one's a long one. All right, exercise 12.2. So Hampton Company reports the following information for its recent calendar year. Changes in current asset and current liability accounts for the year that relate to operating activities follow. So their accounts receivable account had a 10,000 increase, merchandise inventory had a 16,000 decrease, and salaries payable 1,000 increase. So what they want us to do is prepare the operating section of the statement of cash flows for Hampton Company using the indirect method. So indirect method starts with net income, right? You add back non-cash activity and then you add the changes in your current assets and current liability accounts. So let's start with our cash flow from operating activities. First, we take net income, which they give us up above, 24,000. Then we add back any non-cash activity. So the only non-cash activity item that we see here is depreciation expense. So depreciation expense is a reduction before you get to net income, right? So that's not a cash related thing. So if we're starting with net income and our goal is to report the cash activity, we have to add that back or take the effect of it away, right? So we'll add back our $12,000 of depreciation expense. Then let's analyze the changes in the current asset and current liability accounts, which they list above. So if accounts receivable is increasing, the impact on cash is the opposite, right? Because that means you're not collecting as much cash, you're doing more sales on credit. So it's a reduction in cash of 10. Then merchandise inventory is a $16,000 decrease. Well, when you buy inventory, it reduces your cash, right? So if you're not buying as much of it, it's increasing your cash. Okay. Salary payable, you have $1,000 you haven't yet paid. It increased. So increases in payables mean you haven't yet paid the cash for them. So those are also increases in cash. So you have total adjustments to net income for cash related activities, 19,000. So that means that your cash provided by operating activities is going to be the sum total of your 24 plus your 19, or $43,000. All right, this is the same problem. Why don't you take a minute, compute the cash flow from operating activities, and when you're finished, resume the recording and we'll go through the answer. All right, so prepare the operating section of the statement of cash flows for Hampton using the indirect method. Under the indirect method, we start with net income, 20,000. They give us that right up here. Adjustments to reconcile net income to operating cash flow. So first you have to add back your non-cash items. So that in this example is only your depreciation. That's the only non-cash item. So we increase our cash by $5,000 or increase our net income by 5,000. Then we have an increase in accounts receivable of 6. That means we're taking more sales on credit, which means we're getting less cash. So that's a decrease to cash. Merchandise inventory decrease. We're not buying as much inventory as we did last year. So decreases in inventory or increases to cash. Salaries payable increased by 600. So we haven't yet paid our salaries. So that means we have more cash. So we have increase or a positive 600. $20,000 of net income plus $2,600 of the net of all your activity there. Means we have net cash provided by operating activities of $22,600. Okay, hopefully you did well in that one. Let's move on to the next. Exercise 12.3. So the following income statement and information about changes in non-cash current assets and current liabilities are reported. Prepare the operating section of the cash flow statement using the indirect method. All right. So when we do indirect method, we start with net income or net loss. In this case, we have a net loss of $16,000, right? We have to add back our non-cash activity. So that's going to be our depreciation expense of $14,600. And then we take into account all of the increases and decreases in our non-cash current asset and liability accounts. So think of your balance sheet, the current asset section, current liability section, all the accounts that fall there. So let's look at these. So first we have a decrease in accounts receivable. So if we have a decrease in accounts receivable, that must mean our customers are paying us. And when they pay us, they have to pay us cash, right? So decreases in accounts receivable are increases to cash. Then we purchased a machine. Well, what do we know about machine? That's not an operating activity, right? So we can skip that one. Then what about our increases in salaries payable? So as our payables increase, that means we're not yet paying the money out in cash because we're putting a liability on our books saying that we owe it. So we haven't paid the cash. So increases in payable accounts are going to be also increases in cash. And then decrease in other accrued liabilities. So if our other liabilities are decreasing, that must mean that we're paying them because that's the only way they decrease, right? So that's a reduction in cash. So we have net cash provided by operating activities. Sum all those up, $32,600. All right, so this is the exact same problem, different numbers. Why don't you take a minute, compute the operating cash flow provided by our used and operating activities. And when you're finished, you can resume the recording and we can go through the answers. All right, so prepare the operating section of the cash flow statement using the indirect method. So there's all our activity. So we're starting with net income or net loss again. So net loss is 58,600. We just pull that from right here. Then we have to add back all of our non-cash activity. Right? So income statement items go in the opposite direction, right? So first we have non-cash expenses. We add those back. So in this case, we have depreciation. Oh, let me get our little helper box up here populated. Okay, so adjustments to reconcile net income to operating cash flow. So we're going to add back our depreciation expense, which they tell us is $31,400. Then we have our balance sheet items. So we don't have any loss or gain on sales of anything, right? So our change in our non-cash operating assets go in the opposite direction. So we've got decreases in current operating assets. So let's see, we've got decreases in accounts receivable. So our decrease in accounts receivable is going to be an increase in cash because the only way accounts receivable comes off your books generally, or the primary way, is when customers pay you, right? So that means we have more cash. Purchase a machine, that's not an operating activity. Remember, that's not a current asset or current liability. It's long-term. That's an investing activity, so we can ignore it. Increases in accounts payable, or salaries payable, sorry. So increases in salaries payable mean that we haven't yet paid money out for the liabilities we owe, so that's an increase in cash as well. Decrease in other accrued means we have paid other liabilities, and so if we pay them, our cash is reducing, right? So we report that as a negative, sum it all up, and you have net cash provided by operating activities of $7,800. Exercise 12.4. All right, so the following income statement and information about changes in non-cash current assets and current liabilities are reported. And then they give us what looks like an income statement. So they want us to prepare the cash flow from operating activities using the indirect method again, but we have some different information here. So start with net income, right? We make adjustments to reconcile net income to operating cash flow. Those are going to be our income statement items that don't affect cash. Those go in the opposite direction. Then we're going to add back non-cash expenses like depreciation and amortization. We're going to subtract non-cash revenues, equity method earnings. We're going to add loss on sale of long-term assets. We'll subtract any gain on sale of long-term assets. Then we have our changes in our current assets. So changes in non-cash operating assets go in the opposite direction. So we have decreases in current operating assets are going to be added back. Increases are going to be subtracted. Then we have our change in non-cash operating liabilities. Those go in the same direction. So increases are also increases to cash, and decreases are also decreases to cash. All right, so let's try it. So we're going to start with net income. So they tell us that net income is $481,540. We need to add back any non-cash expense items. So if we look down through the income statement, I see depreciation expense as a non-cash, and I see amortization expense as a non-cash. So let's add both of those back. Then we need to subtract any gains or add any losses, or other way around, sorry, we need to subtract any gains. Oh yeah, subtract any gains, add any losses. I said that right. So we have a gain on sale of equipment. That's a book gain. It's not a cash transaction. So we're going to subtract that. And then we need to look at our current asset and current liability account changes. So accounts receivable increased by $30,500. Increases in asset accounts or decreases in cash. We had merchandise inventory increased by $25,000. So again, increases in asset accounts are decreases in cash. And then we have accounts payable decreasing. Decreases in accounts payable or liability accounts are also decreases in cash. Those are the same direction. And then we had a decrease in payables, so also a decrease to cash. So it looks like, my goodness, we've used a lot of cash, right? Sum it all up. Net cash provided by operating activities, $452,240. All right, same problem, different numbers. You know the drill. When you're done, resume the recording and we'll go through it. All right. Prepare the indirect section of, or the operating activity section of your cash flow statement using the indirect method. So here's our box of clues, right? Same thing we've been through. All right, so let's start with net income. Net income is $627,744. They tell us that. Add back any non-cash items, or subtract, depending upon which direction it's going. In this case, we're going to add back both of our non-cash expense items because they were originally being subtracted to get to our starting point. So we want to add them back. Right? Then do we have any gain or loss or anything like that that we need to account for? We do. We've got gain on sale of equipment. So that was added to our net income, but it's not cash. So we need to undo the effect of that, right? So we're going to subtract it. Then we have accounts receivable increasing and merchandise inventory increasing. Well, when assets increase, they reduce your cash. They go in the opposite direction, right? Then you have accounts payable and salaries payable decreasing. Liabilities go in the same direction from a cash flow perspective, so you're going to subtract those. Decreases are subtracted, increases are added in liability accounts. So you should have $622,870 as your cash flow from operating activities. Exercise 12.5. So Fitz Company reports the following information. Use the indirect method to prepare only the operating section of the cash flow statement for December 31st, 2017. All right, so we start with net income, right? So they give us that information. It's $374. They also give us the non-cash activity accounts. So they give us depreciation and amortization. We're going to add those back. Then gain on sale of plant assets. Well, that gain was added in order to get to net income. We want to undo the effect of it, so we subtract. Then we have our increases and decreases in balance sheet data that they give us. So accounts receivable is decreasing. Decreases in assets or increases in cash. So we're going to add those. Same thing with inventory. Prepaid expense increase is an asset. Increases in assets or decreases in cash. They go the opposite direction. Accounts payable and salaries payable. Oh, accounts payable decreases. So liabilities go the same direction. So that's going to be a subtraction. And then salary payable increase goes the same direction. So that's going to be a cash increase. Add them all up. We have net cash provided by operating activities of $466,600. All right, so same problem, different numbers. Why don't you take a try at this one? And when you're done and or you get stuck, resume the recording and we can go through it. All right, start with net income. 420,000, they give us that answer, right? Add back the effective expenses that were originally subtracted to get to your net income, but they aren't really cash. So add back depreciation, add back amortization. We had a gain on sale, but the problem with that guy is that he was added to get to the net income number. He increased it. We want to undo the effect of it, so we subtract it. And then we have accounts receivable decrease. Decreases in asset accounts or increases in cash. They work opposite. Inventory decrease also works opposite, so it's going to increase cash. Prepaid expense increases, so it works opposite because it's an asset. It's going to decrease cash. Salary payable decrease will also decrease cash, same direction. And salary payable increase will also increase cash, same direction. Add them all up, and you get $508,000 of net cash provided by operating activities. All right, exercise 12.6. Salud, I don't know how you say that. Anyhow, company reports the following information. Use the indirect method to prepare only the operating activities section of the statement of cash flows for the year ended December 31st, 2017. We're getting so much practice at this. You guys should be pros by the time you're done listening to this. All right, let's go. Net income, 400,000. Depreciation expense is subtracted to get to net income, but it's not really cash going out the door, right? So we're going to add it back. Gain on sale of machinery. You increased your net income to get to that, right? It was added in that calculation, but we want to undo the effect of it because it's not really cash that you received. It's just a book gain. So we subtract it. Then you have accounts receivable increase. Increases in asset accounts or decreases in cash. Negative number. Prepaid expense decrease. Decreases in assets or increases in cash. Accounts payable increase. Accounts payable is a liability. Liabilities work the same direction, so increases in liability accounts are also increases in cash. Wages payable decrease. Also decrease to cash. So we have net cash provided by operating activities of $436,000. All right, same problem. Same company name I can't pronounce. Different numbers. Why don't you take a minute, prepare the indirect method operating section of your cash flow statement, and when you're finished, resume the recording and we will go through it. Okay. Cash flow indirect method partial statement. Cash flow from operating activities, when you do the indirect method, you start with net income. They give us that. It's 300,000 right here. Then you need to add back any non-cash expense accounts. So we're going to add back depreciation. And we need to undo the effect of any gain or loss. So gains are added, right? In your calculation of net income, they increase it. So to undo the effect of that, because it is a book gain and is not $15,000 cash that we received, we're going to subtract. Then we have our increase and decrease in our accounts. So increase in receivable accounts that are increase in asset accounts work the opposite direction. So increase in asset accounts mean decreases in cash. right? If your accounts receivable is going up, that means your customers aren't paying you. You have more sales on credit, less cash, okay? Prepaid expense decreases in asset accounts work the opposite. They increase your cash. If you're paying less prepaid expenses, you have more cash. Accounts payable increases in liability accounts work the same way with cash. So they also increase your cash, so +4. Wage payable decrease, that means you paid them, which means you have less cash. Decreases in liabilities also decrease cash. Net cash provided by operating activities is $308,000. All right, exercise 12-7. All right, equipment with a book value of $65,300 had an original cost of $133 and was sold at a loss of $14. Then we got some other transactions in B, C, and D, and what are they asking us to do? They are asking us to determine the company's cash flows from investing activities. So let's reconstruct our journal entries and see if that helps us figure out what pieces are cash and what pieces are not, right? So in letter A, equipment with a book value of $65,300 and an original cost of $133 was sold at a loss of $14. Well, original cost of $133, to get it off the books, we would have credited it, right? The loss is $14,000, they tell us, and the book value is $65,300. So $133,000 less $65,300 is our accumulated depreciation. $67,700. I'm going to remove that from the books, right? We have a loss of 14, so we need a debit of 14. In order to make our debits equal our credits, that must mean that we got cash of $51,300 from our sale of our equipment. So cash received from sale of equipment is going to increase our investing activities, right? So we have $51,300. In letter B, we paid $89,000 cash. So that $89,000 cash that we paid for our new truck, we would have credited or debited truck and credited cash, right? For $89,000. So that $89,000 cash that went out the door is going to be a reduction in our cash flow from investing activities. Okay. Then in letter C, we sold land costing $154,000 for $198,000 cash, yielding a gain of $44,000. Well, they tell us we got cash for $198,000. They told us that the land cost $154, and they told us our gain was $44. So we have a credit to gain on sale of land of $44. And we have land that we're removing from our books of $154. 154 plus 44 equals 198, so our debits equal our credits. And we got cash on sale of land for 198, so that's going to increase our cash flow from investing activities, 198,000. Then in letter D, we have long-term investments in stock that were sold for $60,800 cash, yielding a gain of $4,150. So our journal entry would have been cash, $60,800 debit. They told us that, right? We know we have a gain of $4,150, so we'll credit that. And our net to make our debits equal our credits would be long-term investments in stock that we're reducing off of our balance sheet of $56,650. Well, what piece of that's cash? The 68, right? Or 60,800. So we have cash received from sale on long-term investments of $68,000. So if we add them all up, we have net cash provided by investing activities equal to $221,100. All right, so same thing here. Why don't you take a minute, reconstruct the entries, figure out what pieces, parts are cash, place them in your investing section of your cash flow statement, add it up, and compute what you think the cash flow from investing activities is. When you're done, resume the recording. We can go through it. All right. Cash flow from investing activities. So in letter A, we have equipment with book value of 82, original cost of 166, sold at a loss of 34. So our journal entry would be remove our equipment, which is original cost of 166. We need to remove our accumulated depreciation, and we know that cost less book value is equal to accumulated depreciation, or cost less accumulated depreciation is equal to book value, same thing. Solve for that. So 166 minus 82 is 84,000. So we'll remove our accumulated depreciation. We have a loss. We know we debit loss. So we have debit of 34. So what do we need to make our debits equal our credits? 48,000. 166 minus 84 minus 34, right? So our cash from sale of equipment, 48,000 increase, right? All right, letter B. Cash paid for new truck. They tell us is $109,000. Well, you don't actually have to do that journal entry. It's pretty easy. Credit cash, debit truck. So you know your cash is reducing by 109. In letter C, we sold land costing $320 for $415 cash, yielding a gain of 95. So let's look at that entry. What happened to my journal entry here? Oh, that entry is missing. Okay, let me write it out for you. So in letter C, lands costing $320,000. Lands, we're gonna remove it. Excuse me, I've got children yelling at me. Always a crisis. Okay. So land costing $320,000 was sold for $415,000 cash, yielding a gain of 95. Oh, here's the trick. What they're trying to show you. Now I realize it. Sorry. They're telling you what the cash part of it was, so you don't have to figure it out. Oops. Good grief. Hold on. Okay. They tell you get $415,000 cash. So that's an increase of cash, $415,000. Then your long-term investments in stock were sold for $92,100 cash, yielding a gain of $15,500. So you could do the transaction, but they tell you what the cash is too, right? So they tell you that you got $92,100 cash. So that's an increase, $92,100. So really the only one you had to reconstruct to get the cash piece was letter A. So you have net cash provided by investing activities of $446,100. Exercise 12.8. All right, so use the information above to determine the company's cash flows from financing activities. Okay, so cash flow from financing activities. So first let's determine what we need. So we don't need A. Net income is part of the operating piece. Financing, you either finance your company through stock or through long-term debt, right? So we know that we don't need this purchase equipment because that's an investing activity. And I think the rest belong. So proceeds for issuance of common stock, we got $64,000. So we increase cash, $64,000. We pay a cash dividend of $14,600. That's a reduction in cash, right? We paid it out the door. In letter D, we paid $50,000 cash to settle a note payable. So that's going to be a reduction of $50,000. And then in letter E, we paid $12,000 cash to acquire treasury stock. That's also going to be a reduction in cash. So we have net cash used by financing activities of $12,600. Same problem, different numbers. Why don't you take a try at it? And when you're finished, you can resume the recording and we can go through the answers. All right, so we're talking about financing activities. So we don't care about some of the things, right? So letter A, net income is not used in financing activities. And purchasing equipment, that's an investing activity. We don't need that either, right? So when we issue common stock for $73,000 cash, we get money. So that's an increase. When we pay cash dividends, that's money going out the door, right? So that's a reduction. Pay $130,000 cash to settle a note payable. That's a reduction. We're paying our note, right? Paid $116,000 cash to acquire treasury stock. So that's going to be money going out the door as well. So we have net cash used by financing activities, $184,000. All right, exercise 12.9. All right, so I'm not even going to attempt that name. I swear they do that on purpose. We'll call it P Company, PSA Company, Public Service Announcement. Get it? Just kidding. Okay. Reports the following financial information for year ended December 31st, 16. Prepare the, oh, it's some European company. No wonder I can't pronounce it. Okay. Prepare its statement of cash flows using the indirect method. They give us a hint. Each line item below is titled and any necessary parentheses added as it's reported in the statement of cash flows. So what's super easy is they already give you the increases or the decreases, right? So we're doing the whole statement under the indirect method. So indirect method, we start with net income, right? So let's get our statement set up. There's all our pieces. So first we have a net loss. Then we have to add back any depreciation or amortization and any losses or gains, book losses or book gains on any disposal of activity or disposal of assets or sales. So depreciation and amortization, let's add it back. That's $2,497. We're just pulling it from up above. We have losses on disposal of 94. So we need to add that back as well. So let's see, let's cross off the ones we've used here. All right, then we have, do we have anything else that belongs there? Okay, not from a non-cash perspective. So then we have net increase in current operating assets and other. So current operating assets belong in your current section, right? So we have a decrease, which means we have an increase to cash, positive number, right? Then we have cash paid for dividends. That belongs in the financing section. Except for this must be $14 instead of $58. So we have a typo, I think, there. All right, then we have cash from issuance of shares. So that belongs in your financing section. Cross that off. When we issue shares of stock, we get cash. That's an increase, right? Then we've got cash paid for other financing activities. They give it away, right? In the title is the name of it. So we'll bring that down into our financing section. Then we have cash from disposal of plant assets. So that's an investing activity, right? And when we dispose of them and we get cash, it increases our cash. So that's positive, $243. Cash paid for plant assets, intangibles, and others. They tell us that's $2,793. So we bring that down to our investing section. And then they tell us what the beginning cash balance was, right? $11,292. If we have our net cash from operating activities, sum all those up, it's $6,470. Net cash used in investing activities, because it's a negative, $2,550. Cash flow from financing activities, sum up your $327, your negative $14, and your negative $1,995. That's $1,682. The sum of all of those is your net increase or decrease in cash. In this case, it's $2,238. Plus your cash at December 31st, 15 that they tell us means we have ending cash and cash equivalents of $13,530. Okay? All right, why don't you do the same thing with this one when you're finished? Resume the recording and we will go through it. All right, so did you set up your statement this way first? Sometimes that's helpful. We start with net loss. We add back our depreciation and amortization. We add back our losses on disposals. We add back or subtract the net increase or decrease in current operating assets and other. In this case, it's a decrease, so it's an increase in cash. Cash paid for dividends belongs in your financing section. It's a reduction. Cash from issuance of shares of stock, also financing. Cash paid for other financing activities. Well, they give it away, right? Goes in your financing section. Cash flow from disposal on plants, assets, and intangibles. It's going to be increase of $250. Cash paid for plant assets, intangibles, and others, decrease of $1,900. They tell us that our beginning cash balance is $4,000. Add up each of your sections. Net increase or decrease in cash, $4,350, plus your $4,000 beginning. Ending cash balance of $8,350. Okay. Easy peasy lemon squeezy, except for that name. Exercise. Company records total average assets of $1,240.16, $1,510.17. Calculate the cash flow on total asset ratio for both years. Well, we know that our net operating cash flow divided by average total assets is how you compute that, right? So 102,290 divided by 1,240,000. 8.3%. 138,920 divided by 1,510,000. 9.2%. All right, calculate the cash flow and total assets for the 2 years. When you're done, we'll go through it. All right, did you get 7.1% and 7.8%? All right, hopefully you did well on that one and found it to be pretty simple. Let's move on to the next. All right, exercise 1211. The following financial statements and additional information are reported. Okay. I hope they carry this through the next slides or I'm never going to remember what all this says. They want us to prepare the statement of cash flows for the year ended June 30th, 2017 using the indirect method. All right, so first we have cash flow from operating activities, then investing, then financing, net increase or decrease in cash, and we're going to add to it our beginning cash balance, and we'll get our ending cash. So indirect method, we start with net income. So that's 99,510. We're just pulling it straight from here. Oops, I thought that was my highlighter. All right. Then we make adjustments to reconcile net income to operating cash flow. So we have to add back our non-cash activity that was subtracted, or we need to subtract our non-cash activity that was added in the calculation of net income, right? So we have depreciation of 58,600, add back. We have a gain on sale of equipment of 2,000. We want to subtract that, right, to undo the effect of it. Then we have our balance sheet. So let's see our changes in our non-cash asset accounts. So accounts receivable increased by, was it 14,000? So increases in accounts receivable are decreases in cash, right? They work the opposite. So we'll subtract 14,000. Then we have a decrease in inventory of whatever that is. So that'll be an addition to our cash flow statement. We have a decrease in prepaid expenses, which is an addition to cash of $1,000. And then we have a increase in equipment and an increase in accumulated depreciation. Increases in assets are decreases in cash. Oh, sorry. But those belong in the investing section. Back up. So we'll skip those. Those don't belong in this section. Current accounts payable is a current liability, belongs in the operating cash flow section. So that's a decrease of 5. Decreases in current liabilities are also decreases in cash. We have a decrease in wages payable of $11,000, so that's also going to or $9,000. That's also going to decrease cash. We have a decrease of income tax payable of $400, so that's also going to decrease cash. And I think that's all of our current. Okay. So we have net cash provided by operating activities of $151,410. Then we have to look at our investing activities. So that's our property, plant, and equipment changes, right? So we have increase in equipment of, what is that, $9,000, but we need the letters, the additional information to tell us what pieces of that were cash. So they told us that we got new equipment acquired for $57,600 cash. So that's part of it. So we started at 115 and we started at $9,000 of accumulated, right? We're just transferring these down to our T accounts. Then we bought new equipment for $57,600, so equipment increases by $57,600. And then we received cash on sale of equipment that had a cost of $48,600, yielding a gain of $2,000. So we sold equipment that had a cost of $48,600, so we're going to reduce equipment by $48,600. And we have to reduce our accum related to that equipment, which if we did the journal entry, we would learn that that was $40,600. And we had a gain of $2,000. So the book value of the equipment was sold at $8,000, they tell us. So $48,600 cost less our $40,600 accum on it would be $8,000 book value, right? So that's how they come up with this. And since it was sold at a gain of $2,000 and it had a cost of $8,000, that means the cash was actually $10,000. So you have your cash paid for equipment here, reducing your cash flow from investing activities, and then you have your cash received on the sale of $10,000, increasing your cash flows. So that means you've got net cash used by financing or investing activities of $47,600. Okay. Then we go to our financing activities, which is our long-term liabilities and equity. So we have notes payable that decrease by, and there's some letters or additional information that they tell us. But in letter A, they tell us that it was retired at 30, its carrying cost in exchange for cash. So we have a reduction of 30. And then the only changes affecting retained earnings are net income and cash dividends. So we know that our change in our stock issuance, change in stock issuance was increase of 60, 160 to 220. So we issued stock, which means we got cash, so that's an increase of 60. And then they told us the only changes affecting retained earnings are net income and cash. So if we use our formula, we know that our net income was $99,510. So $99,510 plus the beginning balance of $24,100 less dividends, whatever those are, would be how we get to retained earnings of $33,300. So we're solving for the dividend number, and the dividends paid are cash going out the door. So that's a reduction of $90,310. So we have net cash used by financing activities, $60,310. So if we sum up our 151, our 47.6, and our 63.10, we have net increase in cash of 43,500. We know our beginning balance was 44,000, which means our ending balance should be 87.5. Does the math work? 43.5 plus 44, ending cash balance is $87,500, and we match this one, which means we're correct. Okay, so this is the same problem but different numbers. Why don't you pause the recording, take a few minutes to prepare the statement of cash flows, and then when you're finished, you can resume the recording and we can go through the answers. All right, so the statement of cash flows indirect method. Let's set up our sections. So we have our operating, our investing, and our financing. Here's our income statement, which is the data we need to start with. So we're going to start with net income, $84,000, right? Oh my gosh, I think I found, we've got a ton of these pens around our house, and I think I found the one that's actually excellent. And believe it or not, the stylus, it's a Dollar Tree one, and it's fabulous. How about that? All right. $84,000 net income. Then we need to add back our depreciation expense, right? Oh my gosh, I'm in love with this pen. I wish I would have discovered it earlier in the semester. Okay, $57,800. We're going to add that back. Then we have a gain on sale of equipment. Well, the gain was added to get to our 84,000 net income, right? It's not cash. And if that's our starting point for cash, we're trying to get that net income number to be a cash number, not anything else, right? Because that's our basis for our statement. So we need to add back or undo or subtract, I'm sorry, or undo the effect of the gain on sale. So we're going to subtract that. Okay. Then we need our balance. So let's go through the current assets and current liabilities, and let's figure out what the impact on cash is. So accounts receivable looks like it increased by, what is that, $14,100? Did I do that right? So increases in accounts receivable mean you're not getting cash yet, right? Customers are paying on account. So, oh, 18,000, how about that? Don't tell anybody I couldn't do that math. All right, $18,100. The increase in accounts receivable is going to be a decrease to cash. Our increase or our decrease in inventory, we went from 95.8 to 66.1. The difference between those two is $29,700, and that is an increase in cash. We're buying less inventory. Presumably we have more cash, right? All right, then we have prepaid expenses. Our prepaid expenses decreased. Decreases in assets or increases to cash. So we have an increase of cash of $1,900. That's 4,300 less 6,200. Then we go to our current liabilities. So our accounts payable decreased. Decreases in accounts payable are also decreases in cash. They work the same direction. So our decrease in accounts payable, which is our 26.1 minus our 32.3, it's a decrease in cash. Decreases in wages payable, 17,000 minus 7,500, 9,500, decrease in wages payable. We have income tax payable, 3,800 and 2,100, that's a decrease. That's also a decrease to cash, 1,700. So we have adjustments to net income to reconcile to operating cash flow. Total net cash provided by operating activities is 135,500. It's your 84 plus your 51.5. Okay. So let's remove all the accounts from our balance sheet that we've already addressed, and let's look at what we have left. So what we have left is investment in long-term assets, right? So equipment and accumulated depreciation, that's going to go in our investing section of our cash flow statement. But we need some of the information that was part of those additional information statements in letters A through E, I think it were. So we have new equipment that's acquired for $60,100 cash. So that's a reduction in cash, right? 60,100. Then they also tell us that we received cash for the sale of equipment that had a cost of $48,800 and it yielded a gain of $2,400. So if we figure out what the T account activity looks like, we'll be able to know what our cash impact is. So we started at 115,000, right? And they told us we purchased equipment for 60,100, so that goes to the left side of our T account. Then they tell us that we sold equipment that had a cost of 48.8, so that goes on the right side of our T account. So how we got from 115 to 126.3 was a combination of two transactions. One was strictly cash, the 60,100, and then we had a reduction of 48.8 in the other. Well, we have to look at the accum too. So we had accumulated depreciation starting at 10.7. And we knew that the equipment that we sold had a cost of 48.8 and it yielded a gain of 2004, which means the net book value must have been, well, let me write it out. So sold it for cash. So cash we got. Oh, we don't know. We had cost. So our equipment that we removed from our books. Oh my gosh, this pen is so awesome. Was 48.8. Oh my gosh, it writes so well. I mean, this is incredible. Okay. And it yielded a gain of 2,400. So gains are credits, right? So we'll call that gain. And then we have accumulated depreciation we have to get rid of, and we have cash. I am now having Nerf bullets being shot at my head. This is really awesome. Okay. I'm not sure how to take that exactly. Okay, so we had a gain of 2,400, and our accumulated depreciation, how did they come up with that? 57.8. So hold on, let me get my handy dandy calculator. So we've got we have total credits of 51,200. And we need to know what our net book value is. Our net book value plus our gain of $2,400 would be the equivalent of what cash we received. I think we must have to take this information here as a given. So accumulated depreciation was 57,800. So if we have accumulated depreciation of 57,800, no, that doesn't work. They must not have given us enough information. Hang on. Receive cash for sale of equipment that had cost of 48.8 and yielded a gain of 2,400. But we would need to know what the accumulated depreciation was on that asset. I'm sorry, excuse me. Yes, you need to ask Dad that because I'm trying to work. Anytime you see me with these headphones on my head, means I'm recording a class. So I would appreciate not being interrupted. Please ask Dad. I'm sorry. Let's not turn this into a drinking game. Every time they say Miss B, don't drink. Okay. So where are we? I've totally lost my train of thought. Okay, so I don't understand 51.2. Oh, here's how we do this. So now that I've thoroughly confused you, been interrupted 100 times, I should re-record the slide, but we're so far through it, I hate to do that. So I'm sorry, you can fast forward through the nonsense. Okay, so accumulated depreciation, and cash. Those are our pieces. So they tell us what the cost was of 48.8. They tell us what the gain was of 2,400. So we know that our credits are equal to 51,200, which means our debits also have to be equal to 54,200. And they tell us that our I don't know how to do that. Let's see what it says. 39,900. Yeah, we need this number in order to solve for it. So that must have to be a given somewhere that I missed. So we're going to remove our, oh, I wrote all over this. We're going to remove our accumulated depreciation for 39.9, which means we have cash equal to 1,100. All right, so that was a long-winded way. 11,300 is our cash related to letter D. Okay, so you've got your 60,001. We're going to add 11,003 to cash received from sale of equipment. So we have net cash used by investing activities. So to recap the previous slide for a minute, if I thoroughly confused you, we needed to know what the accumulated depreciation was on the asset that they sold in order to solve that problem. And that was the piece we were missing until I forwarded through the T account. So I'm sorry if I thoroughly confused you. If I did, I'm happy to explain it. Just reach out. Okay. So used by investing activities for $48,400 or $48,800. Then now we've removed our accounts related to that section of our cash flow statement. So now we have to do our cash flows from financing activities. So we've got a $25,000 note payable that's retired at its $25,000 carrying cost. Okay, so note payable is retired for $25,000 book value in exchange for cash. So our cash is going to decrease by the amount that we had to pay to retire our note payable, right? 25,000. Then we have common stock increased by, what is that? $49,000. So common stock that we issued is going to increase our cash, $49,000. That one goes away. And then I believe they tell us that the only changes affecting retained earnings are net income and dividends paid. So if we're starting at $79,000 or $7,900, right? All right, so we have $7,900 starting balance, and we know that retained earnings increases by net income and decreases by dividends, right? Equals ending retained earnings. So if we remove that ending retained earnings and we make that equal to 24,900, and we know what our net income is, right? So let's erase that piece. I gotta start over here. I wrote too small. 7,900 plus income of 84,000, right? Minus dividends equals 24,900. If we solve for dividends, that must mean that we paid dividends of 67,000. 7,900 plus 84,000 minus 67,000 equals 24,900. So then we have net cash used by financing activities of $43,000. If we add up our 135, our 48.8, and our 43, net increase in cash is $43,700. Add our cash balance at the beginning of the year of $57,100. We should get cash at the end of the year of $100,800, which is also equal to the comparative balance sheet cash, which is what you want, right? So hopefully you did well on that one. Sorry for the confusion there in the middle and the 1,000 interruptions. Such is life when you're trying to do some work on a Saturday. All right, moving on. So now they want us to compute the company's cash flow on total assets ratio for fiscal year 17. So we have operating cash flows divided by average total assets. So we have operating cash flows of 135,500 divided by average total assets. You would take this plus this divided by 2. Which means the total asset ratio is 41,000 or 41%, 41.5%. Jeez, oh Pete's. Well, I don't know about you, but I guess I'm glad the semester is almost over too. All right, carrying on. Exercise 1212. So, here are the financial statements and additional information that they give us. And they want us to prepare the statement of cash flows for the fiscal year, or for the year ended June 30th, 2017, using the direct method this time instead. Okay, so direct method, we don't start with net income. We just start by identifying the activities in the operating section, right? So, let's report our journal entries here. So we have sales of 678,000. We have accounts receivable of 14,000. That's a change, which means we must have collected cash of 664,000. So they're saying that we have sales of 678,000. Well, those sales only hit one of two accounts, either your other side to your sales transaction is a debit to cash or it's a debit to accounts receivable. And so what you know is that the difference between your balances on your accounts receivable at the end of the year and at the beginning of the year, your account receivable increased by 14,000. So that means between your cash sales and the amount of sales that the amount of accounts receivable that have been paid during the year is going to be equal to your cash. So so your sales less your change in your accounts receivable is the amount of cash that you've collected on those sales during the year. Okay, so that's entry number 1. So we have receipts from customers equal to 664,000. Then we've got to record the journal entry for our cost of goods sold. So we know that we have cost of goods sold equal to $411,000. That's our debit. Our change in our inventory and our change in our accounts payable. So accounts payable decreased by 5, so that's a debit. Our inventory decreased by $22,700. Or yeah, $22,700. So that must mean that the cash related to our inventory and our payables, we sent $393,300 out the door for payment for merchandise. Okay. Then we've got, let's see. So we've handled all of those accounts. Then we have other expenses. So let's see. We've got $67,000 of other expenses. We have changes in our other miscellaneous payable accounts. So wages payable went down by 9, right? That's the difference of those two. So there were debits of 9 to our wages payable account, and there were debits of 4 to our income tax payable account. And there were changes in prepaid. Our prepaid went down by $1,000. Oh, they don't include wages, or they don't include taxes payable in this one. Sorry, hold on. All right, so let's just look at our other expenses and our prepaid accounts and our wages payable accounts, right? So wages payable decreased by 9, prepaid expenses decreased by 1,000, other expenses running through our income statement of 67,000. So that must mean that cash related to just run-of-the-mill operating expenses was $75,000. So we're going to reduce our cash from operating activities by $75,000. Then we've got, let's see, income tax expense. So it's on its own line. So we have a reduction of $400, right? But we report income tax expense here on our income statement of $43,890. Our income tax payable account reduced by $400, which must mean that we've paid cash related to income taxes of $44,290. Okay. So we have total cash provided by operating activities of $151,410. All right, so let me get rid of all my highlights here. All right, so now cash flows from investing activities. So let's see. So we have new equipment acquired for $57,600 cash, they tell us. So that's easy peasy. So we have 115 that we're starting with. We have 9,000 accumulated we're starting with. We bought another 57.6, they tell us, so that gets posted to the left side of our T account. And then they tell us that we received cash for a sale of equipment that had a cost of 48.6, yielding a gain of 2. So cash paid for equipment first is going to reduce our cash, $57,600. So we'll put that up on our cash flow statement. Then they tell us that so if we start at 9 and we're ending at 27, that means we had additional accumulated depreciation of 58,600 less the oh, here they go. Here's the information they give us. So The book value of equipment was $8,000 that we sold. It had a $48,600 cost and it had $40,600 of accumulated depreciation. So 40,600 we're going to remove from our books. The cost of 48,600 going to remove from our books. It was sold at a gain. So if it's sold at a gain and we got $2,000 plus our cost of 8 is going to be a total of $10,000 of cash. So cash received from sale of equipment, we're going to increase by 10. Net cash used by investing activities is $47,600. All right, then we have activities, right? So they tell us that we retired a note in exchange for $30,000 cash. So we're going to reduce our financing section by $30,000. Then they tell us that we issued some stock, right? Because it went up. So we got $60,000 additional dollars, increased cash. Then we have the retained earnings section of our cash flow. So they tell us the only changes affecting it were net income and cash dividends. So the way we figure that out is we have our total net income, total beginning balance of 24, plus our net income of 99,510, less dividends equals the ending balance of 33. So if you solve for dividends, you get $90,310. So that's going to be a reduction in cash. We're paying dividends out. So we have net cash used by financing activities of $60,310. So you add up 151, 47, and 60, and you get net increase of cash of 43,500. Add your beginning cash balance of 44 to it. You should get ending cash of 87.5. Okay, so the difference in the direct method is that you have to figure out via journal entry how the activity on your income statement netted with what's still sitting on your balance sheet to compute the payments for merchandise, payments for other expenses, payments for taxes, and receipts from customers. Okay. All right, so here's an alternative example. Why don't you take a few minutes, go through it, and when you're done, you can resume the recording and we'll go through the answer. All right. So cash flow from operating activities, direct method. So we first have to figure out the journal entries or what the payments or the cash related activity is for the related items on our income statement and our balance sheet. So if we had sales of 672,000, that would be total credits or net credits, right? Of 672,000 during the year. And we still have accounts receivable on our books of $67,700. Which means it's changed by 18,100 during the year. It's increased, right? So accounts receivable has net increases, so debits of $18,100, which means that the rest of the sales must have been collected in cash. So we had receipts from customers of $653,900. All right, then we have to figure out our cost of goods sold. So we have cost of goods sold of $410,000. We have ending inventory still sitting on our books of $66,100. So that's a decrease in our inventory account of $29,700. It's our 66.1 minus our 95.8, which must mean we have a change in payables because that's how we would inventory that we purchase if we haven't yet paid cash for it. It would still be sitting in our accounts payable. So we have a reduction in accounts payable equal to $6,200, 26.1 minus 32.3. So that must mean that the cash that I have paid out for inventory is $386,500, or for merchandise. Okay. Then if we look at our other expenses, our income statement says we have $66,600 in other expenses. We have a prepaid expenses and wages payable, they tell us relates to other expenses on the income statement, so that's key to know, right? So we have a decrease in our prepaid expenses of 1,900. We have a decrease in our wages payable of 9,500. So that must mean the net cash we paid out for expenses is $74,200. All right, then we have our income taxes. So our income taxes are $56,000. We have a reduction in our income tax payable account of $1,700, which must mean that we've paid cash of $57,700 for income taxes. So let's reduce that, $57,700. So we have net cash provided by operating activities of $135,500. All right, so now if we look at our investing activities, we've got equipment and accumulated depreciation. So we started at $115,000 of equipment. We ended at $126,300. We started at $10,700 in accum, and we ended at $28,600. They tell us we bought new equipment for $60,100 cash, so we're going to reduce our cash flow from investing by that amount. And we're going to add that to the left side of our T account, right? Because we would have debited cash and credited, or debited equipment and credited cash, right? Then they tell us in letter D that we received cash for sale of equipment that had a cost of $48,800, so we're going to remove that. And it yielded a gain of $2,400, but we also need to know what the accumulated depreciation was on that. And they tell us that it was $39,900. So our gain would be equal to our net book value, or our cash would be equal to our net book value plus our gain, right? So if we had a cost of $48,800 less than a cum of $39,900, we have a book value of $8,900 plus our gain. Means that cash received from the sale was $11,300. Okay, that's an increase to investing activities. So we have net cash used by investing activities of $48,800. Then cash flow from financing activities. So here's our financing related accounts. So we retire a note for $25,000, so that's going to reduce our cash flow from financing activities. We paid off our note, cash went out the door. Our stock increased by $49,000, so we're going to increase our cash flow from financing for the additional stock we sold in exchange for cash from our stockholders, right? Then they tell us the only changes affecting retained earnings are net income and cash dividends paid. So if we have retained earnings starting at $7,900, ending at $84,900, and we know that our net income was $84,000, I believe, from the previous slide. That must mean that our cash paid for dividends is $67,000. So if you add up your $135,500, your $48,800, and your $43,000, you have net increase in cash of $43,700. You add that to your beginning cash balance of $57,100. You should get ending cash of $100,800, which equals your balance sheet. Okay? So then they want us to compute the company's cash flow on total assets. So that's operating cash flows divided by average total assets, right? So we have operating cash flows of $135,500 divided by average total assets, $338,315 divided by 2. It's going to be equal to 41.5%. Okay? Okay, exercise 1215. All right, so they want us to, in each of the 3 separate cases, use the information provided to compute the required cash flow information. So in case X, compute the cash received from customers using this following information. So if we have sales of $515,000, that's credit, right? And our change in our accounts receivable balance is a decrease of, what is that? 5,400. So, oh, I'm sorry, increase. This is 17 and then 18. So we have an increase of $6,400 in our accounts receivable. So that means additional debits, right? So that must mean that the cash is your plug. So we received $508,600 of cash from our customers. Okay. So in case Y, they want us to compute the cash paid for rent. So if we know our rent expense is $139,800 and our change in our rent payable on our balance sheet is a reduction of, what would that be, $400? So our rent payable decreased by 400, so, or 1,600, sorry. I should not try to do math without a calculator, my goodness gracious. Um, oh, that's like the easiest math problem too. I should re-record this so you guys don't realize how dumb I am. Okay, um, never mind. So rent payable went from 7,800 to 6,200. So we had a decrease of $1,600 in our rent payable. So that must mean that the cash that we paid for rent is the expense plus the change in the payable of $141,400. In case Z, cash paid for merchandise, if we know cost of goods sold is $525,000, we know our change in our payable and our change in our merchandise inventory, we can compute the cash paid for merchandise. So we have cost of goods sold of $525,000, normal balance of a debit. Our merchandise inventory is changing by some amount that I'm not going to try to compute till it tells me the answer. So we have merchandise inventory decreased by $28,200. So that's credit. Accounts payable increased by 15,300. So that must mean that the cash paid for merchandise is $481,500. We just plug our credit to make our debits equal our credits. All right. So same problem, different numbers. Why don't you take a minute to compute the cash for the various items? And when you're done, resume the recording and we'll go through the answer. Okay. So compute cash received from customers. So we have sales of 430,000 credit. Our accounts receivable increased by $16,340, 59,340 minus 43, right? So cash received from customers is 413,660. Compute cash paid for rent. So rent expense was 105,600. Our change in our rent payable went down a little bit. So that's a debit of 1,290, which must mean the cash we paid for rent is 106,890. All right, cash computed for cash paid for merchandise. We know our cost of goods sold is 445. That's a debit. Our change in our merchandise inventory, it went down. So we credit inventory to decrease it, right? So our merchandise inventory went down by 23,000 or 25,389. And then we have a change in accounts payable. Our accounts payable went from 59,241 to 73,459. So that's an increase of 14,218. Debits equal credits, so that must mean we need a cash credit of 415,393, which would be the cash paid for merchandise, right? All right, exercise 1216. So the following income statement and information about changes in non-cash current assets and liabilities are reported, and they want us to prepare the cash flow from operating section using the direct. All right, so using the direct method, we have to compute what our cash is for all those items like we just did, right? So our cash flow from operating activities, let's see what our cash flows are from our sales, right? So if we know sales are 1.828 mil, and we know our change in our accounts receivable is a decrease of 30,000, or an increase, sorry, of $30,500, that must mean that our cash collected from customers or received from customers is $1,797,500. All right, then let's look at our cost of goods sold. So our cost of goods sold was $991,000. So we know that either our merchandise inventory is either sitting on our balance sheet still, or it went through our cost of goods sold on our income statement. So our change in merchandise inventory is a $25,000 increase. And then our change in our accounts payable, right? Because that's how we pay for our merchandise. If we don't pay cash, it's sitting in our accounts payable. So if we have a decrease of $12,500 in our accounts payable, that's a debit, which must mean the credit that we need to make our entry balance is $1,028,500 in cash paid for merchandise. Then we have, what do we have? Other expenses. Okay, let's look at salary expense. So we have salary expense of $245,535. We have a decrease in our salary payable, which would be a debit, right? You reduce liabilities with debits. So you have a debit of $33,500, which must mean that our cash paid for salaries is $249,035. Debits must equal our credits. So we have payments for salaries, a reduction of $249,035. Then we have payments for rent. So payments for rent were $49,600, and we have no rent payable on our books here. So that's why we just assume that all $49,600 of that is cash. Then we have payment for utilities. We have no utility payable, right? So we assume that all $18,125 is cash. So we have net cash provided by operating activities of $452,240. All right, same problem. Do the same thing using these numbers. When you're done, resume the recording and we can go through the answer. All right, so let's see. So let's look at our cash receipts from our customers. So we make sales either on credit or on cash, right? So the change in our accounts receivable, in addition to our sales, would tell us what our cash is on our sales. So we have sales of $2,012,000. We have an increase in our accounts receivable, so that's a debit of $18,100, which must mean that the cash we've collected on our sales or cash we've made, cash sales that we've made, total $1,993,900. Then we have cost of goods sold. We know that the inventory we purchase is either still sitting in inventory at the end of the year, or it's blown through our income statement in the form of cost of goods sold, right? So we have cost of goods sold of $985,880. We have a change in our merchandise inventory account of an increase of $18,002, and we have a change in our accounts payable, a decrease of $9,300, which must mean that the cash we've paid for our inventory during the year is $1,013,380. All right, let's look at our salaries. So our salary expense is $275,644. But what we're trying to figure out is how much of that is cash. Well, salary expense less whatever change in your salary payable on your balance sheet is going to tell you, or plus, depending upon which way the change is going, is going to tell you how much cash you've spent in salary. So we had salary payable decrease of $5,550. So that means that we've paid that plus all of our expense in cash, $281,194. So if we prepare our statement, we have receipts from customers, $1,993,900. Payments for merchandise, $1,013,380. And salary, $281,194. Payment for rent, there's no rent payable on our balance sheet, so we can assume all that rent expense is cash. Utilities, there's no utility payable on our balance sheet, so we can assume that is all cash. So we have net cash provided by operating activities of $622,870. Okay, hope you did well on that one. Exercise 1217. So use the above information. They want us to prepare a complete statement of cash flows using the direct method for the year ended December 31st, 17. All right, so cash flow from operating activities. We know that our cash and cash equivalent balance is $40,000 to start the year, so let's plug that in. We also know that at the end of the year, it's $148, so let's plug that in. Cash received as interest is going to be an operating activity, so that's going to go up top. Cash paid for salaries is going to be up top, is a reduction. Bond payable retired by issuing common stock, and there's no gain or loss on retirement. That's not a cash activity. So that goes at the bottom. Cash paid to retire a long-term note payable. So that's a financing activity. That's going to be a reduction of $100,000. Cash received from sale of equipment is an investing activity. Cash received in exchange for a 6-month note payable. That's a financing activity, and that's an increase of $35,000. Land purchased by issuing a long-term note payable is a non-cash transaction, so that goes at the bottom. That's not included, right? Cash paid for store equipment, that's going to be an investing activity. We're going to reduce our cash there by $24,750. Cash paid for dividends, that's a financing activity, reduced by 10. Cash paid for other expenses, that's an operating activity, reduction of 20. Cash received from customers, that's an operating activity, increase of $495,000. Cash paid for merchandise, decrease of $254,500. So we have net cash provided by operating activities of $147,000. Net cash provided by investing, $35,500. Used by financing, $75,000. $147,500, $35,500, and $75,000 should be a net increase in cash of $108,000 plus $40,000 cash of $148,000. All right, same problem. Why don't you prepare the statement of cash flows using the direct method? When you're finished, you can resume the recording and we can go through the answers. All right, so direct method, let's set up our sections. Cash and cash equivalent balance at the beginning of the year was 21. We can plug that in. The end of the year, it's 59,052. Plug that in. Cash received as interest, where does that go? It's operating. Cash paid for salaries, it's operating. Bonds payable retired by issuing common stock. I don't see anything cash related in that, right? Put it at the bottom, under non-cash. Cash paid to retire long-term notes payable. That's a financing activity. Cash received from sale of equipment. That's an investing activity, right? Cash received in exchange for a 6-month note payable. That's a financing activity. We received the cash. It's an increase. Land purchased by issuing a long-term note payable. It's an investing activity, right? Oh, I'm sorry. Land purchased by issuing a long-term note payable. So you see, you should read carefully. This doesn't say cash. Not a cash activity. Goes at the bottom. Cash paid for store equipment. That's an investing activity. It's a reduction, right? Then we've got, oh, can I erase I can't erase my line I put there? Yikes. All right, so cash paid for dividends. That's a financing activity. Reduction. Cash paid for other expenses. That is a operating activity, and that's a reduction. Cash received from customers. That's an operating activity, right? Run-of-the-mill income statement activity. Cash paid for merchandise. It's a reduction of $211,848. So you add them up. Net cash provided by operating, $103,152. Net cash provided by investing, $31,500. Net cash used in financing is $96,600. Sum up your subtotals there. You have net increase in cash of $38,052. Add 21 to it, you should get $59,052. All right, exercise 1218. So the following summarized cash T account reflects total debits and credits to the cash account. They want us to complete the statement of cash flows for 17 using the cash provided or used by operating activities should be reported using the direct method. All right, so I don't know why I can't get that highlight to go away, so sorry about that. All right, so they told us we started at 333,000. So beginning balance cash 333. They tell us our receipts from customers are 5 million, so that goes in operating, right? They tell us our receipt from dividends is $208,400. That is an operating expense activity. It's dividends we've invested in the company, and it's on our income statement, so it shows up in the operating section. Receipt from land sale, that's investing, right? Receipt from machinery sale is also investing. Receipt from issuing stock, that's a financing, right? Receipt from borrowing, where's that go? Financing as well, right? Then we made payments for merchandise, that goes in operating as a reduction. Payment for wages is also operating as a reduction. Payment for rent, same thing. Payment for interest, also operating. Payment for taxes, also operating. Payment for machinery is an investing. Okay. Payment for long-term investments, that's also investing. Payments for a note payable is financing. Payment for dividends is also financing. So if you subtotal all your categories, oh, one more, payment for treasury stock is also financing. So we have an ending balance, our debits less our credits of $2,883,400. So we have ending balance of cash of $2,883,400. If we subtotal each of our sections, our net cash provided by, or a net change in cash rather, should be the difference between the $2,883,400 and the $333, or it should, that answer should be the same as the sum of $1,080,000 minus $2,566,000 plus $4,036. So net increase of cash of $2,550,400. Okay. All right, your turn. Prepare it using the direct method. All right, so set up our cash beginning and ending balances in there, right? So cash received from customers, that's operating. Cash received from dividends, that's operating. Received from land sales, investing. Received machinery sales, investing. Issuing stock and receipts from borrowing are both financing. Payment for merchandise is operating. Payment for wages operating. Same thing with rent, interest, and taxes. Payment for machinery is investing. Payment for long-term investments is investing. They give it away in the name. Note payable, dividends, and treasury stock are all financing. So if you add up each of your sections, right, we know what beginning balance of cash is and ending balance from our statements. Should have net increase in cash of $449,000. Beginning balance you pull from the data. Increase plus beginning should equal ending, which you can compare back to the data to make sure you got the right answer. Okay? Okay, guys, so that's it for chapter 12. Hopefully this PowerPoint makes sense to you. I'm sorry about the 1,000 interruptions. And in case you were wondering where the present value tables were that were supposed to be in the PowerPoint for chapter 10, here they are apparently. So that was kind of an interesting find. But anyway, so hopefully you find this helpful. And if you have any questions, as always, don't hesitate to reach out. And I wish you guys the best of luck. This is it for Financial Accounting 215. Hope you guys have a wonderful and successful rest of your academic career, and I wish you all the best. Take care.